I really appreciate everybody taking some time out of your busy days. This will be recorded, so if you want to listen to it at a later time, please feel free to do that. As I mentioned earlier, you'll find in the chat option across the top, there are some resources that are in that chat for you. Please do feel free as well to use the chat to ask questions as we go along. All right, in today's presentation, we're really focusing on giving you an overview of some of the changes that you might expect. And before we begin, I just want to remind you that every situation is going to be unique and different. It might be advisable for you based on the situation that you're in to speak with your tax, legal, or accounting professional about your specific situation and specific concerns. But with that, let's jump in and talk a little bit about our agenda today. It's pretty straightforward. We're going to talk about how this bill impacts us as individuals and families. We'll talk a little bit about the impact it has on business, work, and some other key deadlines, some other key considerations that you might be wanting to be aware of as we go through. Let's start first by taking a look at the impacts on individuals and families. I think these are the ones that most of us have heard the most about. There's certainly a lot of questions about how these might impact us. I want to start by talking through the tax rates and the standard deductions. The tax rates and the standard deductions. The current tax rates are now permanent, or at least permanent through 2030. What we look at here is our tax rate based on your income, single and married filing jointly. I've listed those all the way down for you. The different tax rates are 10, 12, 22, 24, 32, 35, and 37%. One thing to keep in mind, right, as we look at that tax rate, that's our top end tax rate. When we adjust that for our income, what we actually pay is an effective tax rate based on the income that we earn. So for example, if I earned $105,000 as a single person in 2025, I'm not paying 24% on the total, but rather that's the top end of my tax rate. Some other things to note is that we had some changes to the standard deductions and some changes to the state and local tax or SALT deductions. I want to make sure we stop and pause on this for just a minute and make sure that we discuss the difference between the standard deduction and the SALT deduction. The standard deduction is for people who do not itemize, and the state and local tax deduction would be for those folks who do tend to itemize. Generally speaking, there's a lot of situations that we'll look at with people. This is probably something, if you have an accountant or a tax professional that you work with, they're probably giving you advice about which of these deductions might make the most sense for you. It's entirely possible that the SALT deductions might provide a lesser deduction for you than the standard deductions. So that's why it's important to make sure that you're vetting all of these kinds of conversations through with your tax professional. The 2026 standard deduction, though, did increase. It's $16,100 if you're single. And if you're married filing jointly, it's $32,200 for 2026. This is up a little bit from where it was in 2025. The state and local tax, or that SALT deduction that we just talked about, again, this is requiring you to itemize. So when we talk about those itemized deductions, what counts in that state and local tax are going to be things like quarterly estimates to the state, local taxes like to your city, property taxes are often included in this particular item here. That itemization might require a little bit more documentation for you as well. So if that's something you're looking at, be aware of that as a consideration. But that SALT deduction increased from $40,000 in 2025 to $40,400 for 2026. That is anticipated to increase by 1% per year through 2030. The SALT tax specifically. So a couple of those key things just to be aware of. Your standard deduction, if you're one of those folks who just uses the standard, that is going to increase for 2026. If you're one of those individuals who itemizes, the state and local tax deduction has increased for 2026. Now let's talk about some new deductions. The One Big Beautiful Bill Act established a new $6,000 bonus deduction for individuals who are age 65 or older. The deduction is available in addition to that standard deduction that we just talked about. So it is an additional amount. It can be used by each person. So if you're married filing jointly, you could have up to $12,000 in that bonus deduction if you're both over 65. You do want to be aware that income phase outs apply to this. So there's a bonus phase for modified adjusted gross income, or MAGI, above 75,000 if you're single, and 150,000 if you're married filing jointly. Right now, this is a temporary tax deduction, applying just to years from 2025 through 2028. This has been one that I tell you has probably had the most questions that people have asked me about how this works, what deductions you can use, how this might apply. So we have a little case study here that we can walk through. So we're looking at this married couple. We're looking at Robert and Noreen. They're both over 65. The couple is receiving 70,000 in Social Security benefits. Of that, 19,600 is taxable. They also receive some income from a pension. In this case, 25,000 is their taxable pension income. So if we look at this couple who's married filing jointly, their total taxable income would be 44,600. That standard deduction before the OBBA passed put them at 33,000. So they have a taxable income then of 11,400. But that new deduction for seniors can apply. So there could be an additional $6,000 bonus deduction for each filer over 65. They may both be able to use that. So this could really impact how much they have to pay in taxes. If you're over 65, this is probably something for you to chat with your tax professional about, to see if this is something that you could utilize, to see if this might be a way to help you reduce some of that taxable income. Another new incentive that we've seen out of the One Big Beautiful Bill Act is this new incentive for car buyers. This is available if you bought a car in 2025. If it was a new car, there's a deduction that's available for you of up to $10,000 for a new car loan interest, as long as that loan originated after December 31st of 2024. It cannot be for a used car, though. It has to be a new car. The vehicle has to undergo its final assembly in the United States. Has to be a personal use vehicle as well. The last thing to note there is some income phase outs that apply to that. So it's $100,000 if you're single. If you're married, filing jointly, it's $200,000. If you earn more than that, the new incentive does phase out for you. A couple other things I'll point out about this is I learned more about how this new incentive works for individuals. For purposes of the deduction, it has to be a qualified passenger vehicle. It can be a car, a minivan, a van, an SUV, a pickup truck. It could be a motorcycle, as long as its gross vehicle weight rating is less than 14,000 pounds. You can also find out, if you're unsure, where the final assembly occurred. Take a look at the information in the car and the VIN number. By law, every vehicle has to have one, right? And that 17-digit VIN number has a unique combination of numbers and letters that do indicate where it was made. If that starts with a 1, a 4, or a 5, it indicates that that was probably made in the United States. So that might be an easy way for you to check to see if this is something that applies to you. So if you bought a car in 2025, it was a new car, and that loan originated after December 31st, it was assembled in the United States, you can apply for this new incentive and deduct the interest off of that loan. So that's a pretty important one to be aware of if that's not something you knew beforehand. Next up is family credits and support. There's a lot that was passed in that One Big Beautiful Bill that relates to family credits and how we use those. There's a couple I'll spend a little bit more time as we walk through on this, but the first one, just to hit high level, it increased the child tax credit from 2,000 to 2,200. So we got a little bit of an increase in the child tax credit. It expanded dependent care FSA limits from 5,000 a year to 7,500 a year. So if you were using FSA for, like, let's say, your daycare expenses, it did increase there for you. So for 2026, so that should provide you a pretty decent deduction going forward. It also creates a one-time $1,000 government contribution to a special account for children born between 2025 and 2028. Now, this is one I know I hadn't heard a whole lot about, so I wanted to learn more about it and share some of that information with you. Again, in the chat, you'll see that there's a link in there for you from the IRS about Trump accounts, which is what these are kind of nicknamed. What these things allow is we can't make contributions to them. They will not fund until July 5th of 2026. There's still a lot of details that are coming out about how these work. So I would encourage you, if you have a child, if you had a child in 2025, or you might be expecting in 2026, or maybe you're doing family planning for yourself going forward, this is something to take a look at, learn more about, but know that there's still details forthcoming about that. So probably the best place to continue to check in would be on that IRS website. It right now, it would require an investment in a low cost stock mutual fund like an S&P 500 type investment. It allows you to contribute $5,000 on top of the $1,000 credit that you get from the government. If the child keeps it till at age 18, the account will transition to a traditional IRA. There's a lot more information that is out there about those. If that's not something that you'd heard about, I encourage you to go check that out. Spend a little extra time learning about that one. The next one expands the 529 plans to K-12's non-tuition expenses. This is one that, having kiddos that are heading into college, I've been really spending lots of time learning about 529 plans. Right now, there are certain non-tuition expenses that weren't included in those 529s. Now this would allow you through K through 12 to use those 529 plans for curriculum and instructional materials, online education, tutoring, testing, like if your kiddo is sitting for the ACT or the SAT, and you want to cover their expenses, you can do that through the 529 plan. If your child needs educational therapies, you can use that from your 529 plan. It also doubles the K-12 tuition cap from $10,000 to $20,000. So how much you can use for tuition for K-12. Now, when we think about 529 plans, I think we tend to think of them as post-secondary, so for college or maybe trade school or something along those lines. But it's important to note that 529s have always allowed some access to K through 12. This is just really expanding that access and giving you more tools that you could utilize that 529 plan for. The other thing that's added in here, this actually is a little bit of a continuation from the Secure Act 2.0, which passed in 2022. The last bullet, it allows you to do a tax-free transfer of unused 529 plans to beneficiaries' Roth IRAs. You can do that up to $35,000. It's a lifetime limit. The account has to be at least a 12-year minimum account age, and it has to undergo a 5-year seasoning period for contributions. So what that means is if I've had the 529 account established for at least 12 years, if my kiddo decides they don't want to go to college and I still have money in that 529 plan, it's going to allow me to roll that into a Roth IRA for my child going forward. They will need to wait that 5-year seasoning period for any contributions that are being made to that, but it allows a lot more flexibility than 529 plans have had in the past. I think if people had kind of some objection to 529 plans in prior years, really a lot of that was coming from, well, what if my child decides they don't want to go to college and now I put this money in a 529 plan and I'm just going to get taxed on all of that. What this is really freeing up is more flexibility for your child if they decide that college isn't the right path for them. You don't have to take the money you established for them in that account and either have it taxed or assigned elsewhere. So those are some big updates to the family credit supports, some changes to the education and child savings that might be useful for you. The last thing we're going to hit on the individual impact of the One Big Beautiful Bill Act is estate and charitable strategies. They've increased the estate and gift tax. So increased the estate and gift tax exemption in 2026 to 15 million for a single person, 30 million joint, so 15 million per person. It also allows a new above the line deduction for charitable contributions up to $1,000 if you're single, or 2,000 if you're married filing jointly for non-itemizers. So let's say you're one of those people who you're using those standard deductions, not the SALT deductions that we talked about at the beginning. This allows you a little bit more flexibility to deduct charitable contributions. If you've got a favorite charity out there, and you want to make sure that you get a little bit more tax deduction, this is maybe something for you to consider. So just to kind of summarize what we hit on the individual side of how One Big Beautiful Bill Act hits us, the new law provides a mix of new tax law changes, targeted deductions. It just really means the legislation's provided some new ways, some new tools that might be able to help include strategies you already have in place for your tax situation. Again, can't stress this enough. Everybody's situation is going to be a little bit unique. So if you're trying to figure out which of these might make the most sense for you, probably a good idea to sit down and chat that over with your professional. I'm going to stop and pause before we move on to the impact to businesses and some other work and key deadlines, and ask if there's any questions that anybody has so far about what we've discussed. Okay, I don't see any in the chat, so I'll go ahead and move forward. Okay, so one of the big ones for business owners that permanently established the 20% qualified business income, or QBI, for S corps, sole props, partnerships, trusts, or estates. The limits to QBI apply should be really, you want to make sure, again, you're carefully considering this with your accountant. That's something that you're looking at. But this is a pretty notable update. This was made permanent. It was expected to sunset. So this is also restoring 100% of the expensing for capital investments. So if you were trying to reinvest back in your business, you're allowed to expense 100% of that, as opposed to there was kind of a gradient table that was projected to take place. So this is a pretty good change, I think, for business owners, allowing them a little bit more flexibility there. If you are a person who is looking at how does the gig work impact me, maybe you do some work on the side, or you have a kiddo or a loved one or a friend that does some work on the side, you're kind of wondering how this impacts you. The act addresses reporting for gig workers. It reset the 1099K threshold back to $20,000. And it introduced some new specific deductions for service industry workers on tips, and for those folks who are earning overtime, subject to certain limits. So there's a deduction, a new deduction of up to $25,000 for tips. If you have overtime deductions, it's $12,500 for single, $25,000 married filing jointly. Income limits do apply, though, so you have to be mindful of this, and they have phase outs. So if you're single, it's 150,000. If you're married filing jointly, it's 300,000. That's something to really carefully consider, because maybe one of you is in your marriage, maybe one of you works overtime and the other one has a job that does not. You want to make sure that you're looking at your total income to see how this deduction might impact you, and if that's going to change any of the ways that you file. Currently, this law is going to be in effect for tax years 2025 through 2028. So be aware of that. This is, at this point, is not a permanent change to the tax code. It is set to be a temporary one through 2028. Some other considerations as we look at kind of other things that we might want to consider. The OBBBA can provide some new opportunities for deductions, like we talked about. Maybe you're a person who is doing some gig work, or you're a person who works a lot of overtime. There might be some new deductions here to take advantage of. I hope you've learned some new things about, maybe it's time for you to take a look at, do we buy a new car, or you've had a kiddo in the last year, maybe some changes to the way that you put those deductions in place. Take a look at these and see which of these might apply to your situation. The changes to estate and education rules are going to influence a lot of things in terms of how wealth transfers over time, legacy strategies. So might be a good opportunity if you're a person who's already got kind of a strategy built for how you're going to be passing on assets, you might want to take a look at those and see if there's any changes you might want to make. I think there's just really it's always a good time anytime you see legislation and kind of this broad sweeping. It's always a good time to consider your time horizon, your goals, your individual situations. Sit down with a professional and talk through that. Just as a reminder, these legislative environments are subject to change. There's only a few of these that are set to be permanent, and only a few of these that are set to go as far as 2030. So trying to understand which ones of these might apply to you, which ones you can use now, it's going to be important for you to take a look at that. As a reminder, in the chat feature, there is a tax guide available, and then the IRS has also made available the One Big Beautiful Bill provisions. You can see the screen. I'm sure you can here. This is a helpful tool. I know sometimes you get into something like the IRS and it can feel a little daunting to look at all of the different things out there. They've really done a good job in trying to put together some things that are easy for you to read and gather from. It gives you a good place to kind of find all of the things that we've talked about here in one place. So if this isn't a resource that that you've used, I encourage you to take a look at it. It'll go through all of the different kinds of provisions that are out here, what is expiring, what things might be benefit for you. There's fact sheets, tips, frequently asked questions. There's just a ton of resources that are out here for you under this irs.gov One Big Beautiful Bill. I encourage you to take a look at that if that's something that would be beneficial for you. If you have questions about how this might impact you, feel free to ask those. We're more than happy to help you. I want to make sure that you have the answers that you need. So with that, I'm going to wrap this up by asking what additional questions you might have. I want to make sure that we give you opportunities to go ahead and ask those. Right. Well, then I thank you all for taking time out of your busy mornings to learn more about this bill. If you do have questions at any time, maybe you just didn't want to ask those in the call or pop those in the chat, do feel free to reach out and give me a call or shoot me an email. I'm more than happy to help answer the questions that you have. Hope everyone has a wonderful day. Thanks so much for coming.